with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come, trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, February 28th, 2025, end of the week, end of the month, 2 months down for 2025. Hey, some shout outs to Hudson, Brian, Landa, so many folks tuning in and week out. We so greatly appreciate you using this tool to stay on top of what's going on with your money. And another shout out to the cast of Fast Money, the TV show on CNBC, Monday through Friday at 5 p.m. You know, we got our start at BIG 20 years ago. As a matter of fact, we're celebrating our 20th anniversary. You may have gotten an invitation this past week to come out and join us for that. Fast Money got its start 18 years ago. And I've just tuned in pretty much every single night for the last 18 years. These folks have been like a part of my investment committee. I got a chance to hang out with them Thursday night. I got into some good conversations with all of them, Mel, Guy, Tim, Karen, Steve, and even Dan, who tends to be a bit negative, but it was a great time and it's a great show. So really appreciate having some time spent with those guys and had some great conversations. Look, let's just jump into the numbers. It was another crazy week. I feel like I'm a broken record. Another crazy week, another roller coaster ride of a week. Dow Jones finished up, believe it or not, 0.95%, but by the skin of its teeth. It gained 1.4% today, so it just barely crossed over the positive line for this week. And it was negative on the month, down 1.5% for the month of February. S&P was down 0.9% this week, down 1.4% for February. The NASDAQ composite down 3.4%, down almost 4% for the month. And the Russell Small Cap Index down 1.4% for the week, down 5.4% for the month. So all the indices finishing down for the month of February. Now, if you look at your accounts or you get your statements here the next few days, you're like, well, you said everything was bad and down, but we're not down. We made a lot of big changes across all of our models at the beginning of the year. And right now, the diversity is really playing its role, doing the job that we hoped it would do for 2025 to smooth things out. So while the indices were down for the month, we did manage to come out with a positive return across to all the major models. So that was good. Looking at some other things, though, regarding the indices, how about the volatility index? Up 7.8% on the week, as you might expect. But at the same time, it's been pretty tame. The volatility index has had plenty of opportunity to get much uglier and go up a whole lot more than it has. But it's been, kind of like hanging in there. It really hasn't been too terribly bad at the moment. That can change, but it hasn't changed yet. But the big mover, the big story, the TLT, long-term bonds, up for the week. 3.1% for the week, up 5.3% for the month. Big move to bonds. And that's because fear is rising in the market. We'll circle back around to it in a moment. As for the sectors this week, kind of a mixed bag, but the defensive areas tended to do much better this week. Consumer staples up 1%, healthcare up 1.7%, real estate up 2.1%. Just to name a few, financials were the outshining sector this week, up 2.8%. But then other areas really took it on the chin. Things like technology down 3.9% for the week. If we break semiconductors out of there, they were down 6.8%. Retail sales down 1.5%. Discretionary down 1.1%. So the only thing that just didn't fit the narrative were utilities. They were down 1.1% on the week, and they tend to be defensive. But I think a lot of that has to do with the semiconductor stories that have been going about and going around there. They're kind of like joined at the hip at the moment. Increase in chip needs and data centers and AI and all this stuff also equates to an increase in a need of power consumption. And the utilities have been riding this newfound demand for semiconductor chips and these big projects that are going to be put together. But as semiconductors have cooled off, so have some of the utilities. So it's not been quite staying in line with what we would expect the narrative to be there. Gold and silver, both down a bit. Gold down 2.7, silver down 4.3. But again, gold's had a major breakout. I think what's happening right now there is this profit taking. When investors are afraid, when things are uncertain, when they're not really sure what next week's going to hold or next day's going to hold, they tend to pull money out of their winners, take some of that profit and book it. It's the wise thing to do. We did with Alibaba last Friday, right? We sold a big chunk of Alibaba, not all of it, but a big chunk of it for $143 and change. And it finished this week down to $132, down almost 8%. So it's a prudent thing to do. And a lot of times you see the big winners take a hit first, and gold has been a big winner. So what's moving markets? Well, first off is earnings. The market was just kind of doing its thing most of the week until NVIDIA reported on Wednesday. And although they beat on their earnings, they raised their guidance, the stock still got clobbered the following day, down 8%. See, David, explain that to me. How in the world does a company beat on their earnings, raise guidance, and then still fall? You know that the last quarter doesn't matter because we've talked about that on the show, right? What the company just reported doesn't matter unless it's a big surprise. It just doesn't matter. What really matters to the market is next quarter. It's the expectations. It's the guidance. Well, NVIDIA raised their guidance. So David, what's the problem, right? It should be going up. Well, there's another thing we talk about here on the show quite a bit, and that is the rate of change on earnings expectations. I work closely with Nick Rake over at Earnings Scout on this. He monitors all these rate of changes on all the earnings of the S&P 500 and then some. And what's interesting with NVIDIA, although they raised their guidance, they didn't raise it by as much as they've raised it in previous quarters. And the market has this desire, folks, to get ahead of the future. That is what the market seems to always be trying to do. So when it sees a difference in the rate of change, it tries to jump ahead of the line, tries to get in front of not just a lesser raise on guidance, but a negative quarter, maybe next quarter or the quarter after, right? The market's afraid, hey, look, it's dropping. Let's get ahead of it. So that's what we saw this week with NVIDIA. And it kind of took down the space pretty hard. And really the whole market kind of drifted lower with it. On top of that, you've got some economic data that has not been good. We've had fear gauges have been going through the roof. They've been really poor here. A lot of fear, a lot of negative sentiment. We've actually seen some numbers that are historic. We've only seen them a couple times in history. They're so bad. And I think a lot of that is a news cycle. You've got everything going on out there with Department of Government Efficiency, government layoffs, uncertainties abound everywhere. And it just has a lot of these negative sentiment indicators off the charts. That can be a contrarian indicator. When you see everybody getting all bearish and scared, that can be a good sign to buy. So I don't really buy into that or follow the crowd, so to speak. I try to go the opposite way in many cases. But nonetheless, we see the fear out there. We had a low retail sales number. We had higher initial jobless claims. Of course, some of that federal thing kicking in, I believe. And then we had a poor GDP projections. They were pretty terrible. Gross domestic product. As a matter of fact, the Atlanta Fed came out and projected a negative GDP this quarter, a negative. Now, the Atlanta Fed is wrong a lot. Sometimes they're right on point, but a lot of times they're a little off. So we don't want to take that as gospel by any stretch of the imagination. But the fact that they were putting out there a lower GDP expectation, and others are as well, that's concerning. And then add to that, we had a horrific trade deficit number this morning. That wasn't even factored into this Atlanta GDP that I'm aware of. And trade deficits, they subtract pretty much directly from GDP. So we might actually get a bad number here in this coming quarter. Now you say, well, why is that? Why is this trade deficit so bad? I can tell you exactly what's going on there. Corporate America is trying to get ahead of the tariffs. They're trying to get ahead. They're trying to gobble up as much stuff as they can before these tariffs go into place. So that's what they're doing. And we've had this huge influx of foreign goods entering the country. And that's going to be interesting to see how that impacts things. Now, when these things show up in inventories next quarter, that'll add back to GDP. So this could just be a little blip. We'll have to watch it. All of this leads to the politics. I just mentioned tariffs. Well, this 25% tariff that's due to hit Mexico and Canada is still scheduled to go into effect this coming week. There's been nothing to the contrary. As a matter of fact, sources are saying just pretty much count on it. It's going to be going into place. That's a big thing. And there's another 10% going on to China. We mentioned DOGE, right? This Department of Government Efficiency. They've announced massive layoffs are on the way, and market's fearful over that. Now, one of the good stories, well, good or bad, depends on how you want to look at it. The Social Security thing I mentioned last week, 20 million people on Social Security roster, but I had not confirmed whether or not they were collecting checks. Well, over the weekend, last weekend, I did come across news that strongly indicates that they are not receiving money. And then a little shout out to Marcia, who sent me an email, who had also done some homework on that story, pointing out that it looks very, very unlikely that checks are going out to the majority of those people. On one hand, it's a good thing because it means that we're not being robbed of $500 billion a year by sending Social Security payments out to ghosts. So that's great. However, on the other hand, it kind of would have been nice, right? I mean, think about it this way. It would have been a pretty quick fix on $500 billion of our federal deficit, you know? I mean, gosh, turn the spigot off, stop giving ghosts $500 billion a year and save $500 billion on the budget. That would have been a wonderful thing. But unfortunately, we're going to have to do some heavy lifting to find that if that's not the case. So anyway, you can look at it two different ways there, right? And then, of course, coming up here in a couple of weeks, get ready for it. It'll be in the news. Government shutdown. That's going to be probably headline material here over the next couple of weeks, heading into March 14th time period. Normally, the market doesn't pay a whole lot of attention to that noise. And if it does react, it's usually pretty short-lived. And then today, googly muggly, I tell you what, if you didn't watch the news on Friday night, you're drinking your coffee on Saturday morning and you're listening to me before you checked everything else out, wait till you see the story that happened in Washington, D.C. on Friday afternoon with President Trump and President Zelensky from Ukraine. Talk about a meltdown on national television. Wow. Never seen anything like that before. I don't think anyone ever has. It was really something to watch. The market reacted very negatively right off the bat. I mean, they're supposed to be signing this deal on mineral rights, and they're going to have a joint press conference afterwards. It's going to be coming together, singing Kumbaya. It's going to be great. But before all that even got started, when they were in the Oval Office, just on the preliminary meet and greet and saying hi to the press, everyone started talking and things went off the rails in a major way. President Zelensky was asked to leave the White House shortly thereafter. They did not sign their deal. They did not have their joint press conference. The market rolled over really hard during the middle of that press conference. I was watching the markets while I was listening because I always watch the markets. And it rolled over really hard, as you would expect. But then interestingly enough, the market looked past it. And then by the time we got to the end of the day, we had a massive turnaround and a huge push higher on the S&P 500. So why would that happen, right? That's a big question to ask. What in the world turned the market around on Friday afternoon in such a major way? What piece of news did that? I can't find any. It doesn't look like there was any single piece of news. However, there was a level on the S&P 500, 5,800 and change, that the big commercial guys, these big commercial traders, CTAs, they were looking at this level. The rumor was that if we got down to there, they were going to be dumping a bunch of money into the market. Maybe that had something to do with that. We did hit that level during that press conference. We did bounce off of that, and then things were off to the races thereafter. So what does all this mean for you and moving forward? Well, look, things are muddy. We did have that confirmed breakout on the S&P 500, believe it or not, just a week and a half ago. A week and a half ago, it had a confirmed all-time high and ended up finishing a month negative. But we did have that confirmed breakout. So that would tell me to be patient here, to not be too fearful. Markets usually don't confirm breakouts of ranges like that, tight ranges, and then just completely implode. So I would say, we want to be patient here, but there's some key levels I'm watching. I'm actually watching a 57.28 month-end level. It's a certain indicator that I follow very, very closely. When the market breaks this particular monthly indicator, I get very, very, very defensive. But it's a month-end type of thing. As far as between now and month-end, I'm seeing 57.83 on the S&P is a really strong area of support. And of course, there's a 200-day moving average at 57.16. So these are all the levels we're watching, and we'll see how the market reacts to all of this. We do have some news coming out next week. We'll have ISM numbers for manufacturing and services, kind of give us some insight on those parts of the economy. And then we got the big monthly jobs number next Friday. So still some stuff coming. And then you never know what you're going to get when it comes to the geopolitical aspect of things. So that can always shake markets up. Right now, again, I'm not seeing things going completely off the rails at the moment. It's been sloppy. It's been messy. It's been volatile. But I don't think that this is the big one, so to speak. I think the market may go lower before it goes higher, but I do think it can recover before it goes down too far and still give us some positivity moving forward. I get a little bit more concerned as we get closer to the end of the year, really, as some of this economic data, if it continues to weaken, that's something we'll be very mindful of and starting to prepare for. So look, I am going to go ahead and wrap up this week's edition of the podcast. But hey, look, as you're thinking about your future, your long-term goals, all the things you want to do with you and your money, hey, maybe start that brand new business. I was talking to a guy named Joey in New York City at the Playwright. I was having dinner, and he is looking to start his own business up there in the city. So good for you, man. Hey, maybe it's buy that second house, retire a little early, put those kids through college. You know what your goals are. Don't just think about it. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.